For more information, please visit SGMAC Associates website.
Hi, here's another example. I'll include in the same lecture, in lecture 3. The previous part was talking about economic factors, and I had a problem with it, a numerical problem. Here's another example. I've titled it as a refinancing of a loan. It ties well with the first part, the very previous problem, where you're trying to find out how to repay a loan of $300,000 over 30 years at a 4% APR compounded monthly. So sometimes what happens, we talked about that when we solved the problem, that for budgeting purpose, people typically get into a fixed payment loan. Every month you got to pay this amount for the money that you have borrowed. It helps you to budget. But what happens is, sometimes as the interest rate is a dynamic entity, as it drops in value, the bank allows you to rewrite the loan at a lower interest rate. Bank will charge a service fee to close the existing loan and and rewrite the loan with new interest rate. You'd like to do that. It's rational if it lowers your monthly payment. So the term used is refinancing, and if you haven't done it, it's typical that when you get into 30-year loan, and if you don't try to pay it out soon enough, you just let it pay annual monthly payment of fixed amount, you may come across a situation where there's an opportunity for refinancing, and refinancing may be helpful to you. So we are looking at the mechanics of it through this example. It is advisable to look into refinancing current mortgage payment plan when the interest rate drops. So when the interest rate drops, the bank allows you to refinance. Now it's your call whether you want to go that route or not. Bank will do at a service fee. So here are the problem parameters. You borrowed a loan from bank of $400,000 to finance a new house. You're required to repay the loan in 30 years, 360 equal monthly payment starting at the end of month 1. The bank is charging a 6% APR compounded monthly. So it's charging a 0.5% rate per month. So you borrowed $400,000. You want to repay it in 360 payments, and your interest rate per period happens to be month here is 0.5%. So you want to find out what's the annuity payment. So you got to use the capital recovery factor here, A over P. Your P is 400,000 and parameters are 0.5% per period and 360 time period. So that factor will come out from the table, and it is 0.006. So your payment is $2,400. Okay, so you pay $2,400 at the end of every month for next 30 years to repay a loan of $400,000 at 0.5% interest rate per month. Now the question is, you are into the payment plan for 5 years. You have made the 60th payment, and now the bank is offering you to refinance it because the interest rate has dropped from 6 to 5%. Question is it worth it? Should you go for it? You got to pay a service fee to rewrite the loan, but with a lower interest, there's a potential that you may have a lower monthly payment for the remaining part of the loan. You have made only 60 payments. You still got 300 payments to be made. Refinancing is desirable if it lowers the monthly mortgage payment and the lower interest rate. Not hard to understand. If I have to pay less monthly payment, then of course it's preferable. Remember that the bank will charge a service fee to close the current loan and rewrite a new loan. So what is the new monthly payment? So how do you solve this problem? Basically, what you got to do is find out the new monthly payment at a lower rate, and if it is less than that, less than the current payment, then you can make a decision. Yep. So what you got to do is you got to find out how much, what is the remaining balance of the loan that I have taken after paying 60 payments. And we have seen this kind of problem before. Whenever you want to make some correction during the planning period, you got to find out what you borrowed and how much is remaining at that particular point in time, not when you borrowed. Your time period here is month 60. You are at t equals 60. Your whole planning horizon is 360 payment, 30 years. So what is the remaining balance of the original loan after 60 payments? And we have talked about it before, and we know how to compute that. We simply find out the future value of the loan. If you didn't pay anything, we subtract the future value of the money that you have paid towards that loan. So 400,000 multiplied by the factor f over p, 1/2 60. Again, in this case, we are moving 400,000 from present to future, 60 months into the future at 0.5% rate per month. That amount is what the loan amount would have been if I didn't pay anything. From that, I subtract the future value, computed at time t equals 60 for all the money that I have paid. And that comes through converting an annuity to future payment. $2,400 is annuity, and I want to find the future value of that annuity, 60 payments at the end of 5 years. So after proper discounting, the number comes out to be $372,000 and $372,152. So interesting to note that the initial amount borrowed was $400,000. After 5 years of making payment of $2,400 each month, your actual loan amount has dropped to only $372,152. Okay. So later on we'll solve a problem that shows towards the end the loan gets repaid quicker because your interest burden drops and you make more and more payment towards the principal, and that lowers even more your interest burden. So that's the with it. Now here comes the variable part. Bank will ask for a service charge, and that could be a fixed amount. Most logical thing is a percentage of remaining balance. So I've taken as 1% service charge. There's no uniformity of this service charge from the banks. Each bank may charge differently. Sometimes they use that as a differentiator so that you go from bank A to bank B. So close it with bank A and move it to bank B, this sort of thing. So what's the 1% service charge will do? We add it to the remaining balance. So bank will rewrite a loan of amount 1% added to remaining balance. So that becomes $375,873.52. Now this new loan has to be repaid at 5% APR. That's the whole reason that you are taking this exercise. The interest rate has dropped from 6 to 5%, but unless you compute, you won't know whether there will be some acceptable drop in will there be a drop in monthly payment or not, because there's a cost of 1% to you. So the new loan has to be repaid at 5% APR without increasing the length of the plan, 360. So we have just said that after refinancing, I'll not increase the length of the period. It will still be, I'm in 5th year of a 30-year loan. So I got 25 years left of that loan. I'll repay it in 25 years at a lower interest rate. And what's the new annuity payment? So in this case, our interest rate has dropped from 6 to 5%, compounding frequency 12, so I have written 5 over 12%. Factor is same A over P because I know the present value of that loan at the end of year 5, and I want to get the annuity for if I repay it in 300 payments. So it changed to 300 because we're talking about 20 years left of the planning period, 25 years left. That number comes out, this factor 0.0058, I've computed using the expression for A over P by putting an appropriate value for I, because this is not readily available in the table. Okay, so so that number comes out to be $2,180.06. Your previous payment was $2,400. After 5 years, the remaining balance you pay 101% service charge, and then rewrite it at 5% APR compounded monthly scheme. Your new annuity payment comes out to be $2,180.06. So you have a reduction of monthly payment of $219, almost to $20. You have a reduction of monthly payment of almost $220. So the question is refinancing desirable? Answer is yes, because that's a good amount of money. You're lowering $220 of monthly payment, simply rewriting the loan. Even 1% service charge is leading to a good drop in monthly payment. So yeah, in this case, refinancing is advisable. So question, the purpose of this exercise is to how to compute the numbers so that you can take the decision when you're given an offer for refinancing whether you should go in for not. Now, this application you'll find in real life quite a bit, but in our case, it is an example of first finding out using capital recovery factor, annuity payment, then finding out how much remaining of the loan at an arbitrary point in time. We add a service charge, then use the capital recovery factor again over a smaller period of time to find the new payment. A reduction in monthly payment will lead us to take a decision. Yes, we want to refinance. Okay, so that's the basic problem. Again, get familiar with it, read the problem statement, cash flow diagram, and how to what are the factors to use, at what point in time you're taking the decision. In this case, you are moving from initial time t equal to 0 to t equal to 60. That's when you're taking a decision that I have already paid 5 years. What's the remaining balance now? I rewrite the loan. So from then on, it's for the remaining 300 periods, what's the new payment? Okay, fairly simple example. Again, a good real world example. This is the problem we started with, used car problem. And again, be familiar with the use of the factors. Okay, so this will be part of your lecture 3, and I'm going to add some more discussion. I have a set of problems that I have posted, and I have solved some of them, and I'm going to discuss a few more problems from that set to this part of the lecture. Okay, so that's where I'll stop. This will be part of your lecture 3, refinancing of a loan. Okay, bye now. Hi, we are posting materials online. If you have any doubts or any questions, uh, regarding the materials posted, feel free to get in touch with us through email. Um, Provide your name, address, school name, your contact information. We also welcome if you provide comments so that things can be improved upon. We also appreciate if you provide any feedback. Okay, so let us know what do you think about the material posted. Okay, bye now.
For more information, please visit SGMAC Associates website. For more information, please visit SGMAC Associates website. For more information, please visit SGMAC Associates website.